Today we're tackling something pretty complex, but honestly fundamental to the U.S. economy, the mortgage market.
Yeah, it's huge. And if you've ever felt like, your interest rate was decided somewhere far away by forces you couldn't see, well, you weren't entirely wrong.
So that's our mission today, right? To understand the sheer plumbing involved in keeping that market liquid.
Exactly. We want to trace a mortgage loan basically from the moment you apply, maybe at your local bank, and see how global economic policy shapes that, and then how it ends up with these, well, institutional giants.
Who buy and sell that debt, essentially recycling the capital.
Right. It's a whole system. You've got policy, economics, and these two really distinct markets, the primary and the secondary.
Okay, let's unpack that from the very top then. Before any loan officer even talks numbers with you, there are these massive sort of macroeconomic forces at play. They're deciding whether your 30-year fixed rate is going to be high or low. Where do we start with that?
Well, we really have to start with the general health of the economy, specifically thinking about inflation risk. I mean, lenders, fundamentally, they want to protect the value of the money they're lending out over, say, 30 years.
30 years is a long time for money to lose value.
It really is. So if they think inflation is going to erode that value, they're going to demand a higher return, a higher interest rate. And to gauge this risk, they look at key economic indicators.
Okay, like what?
Well, the first big one is gross domestic product, GDP. That's the total dollar value of all goods and services produced.
Right, and if GDP is climbing really fast, maybe too fast, it suggests the economy is overheating, which could lead to inflation.
Precisely. And the other key indicator tracking inflation more directly at the consumer level is the CPI, the Consumer Price Index. It measures the average price changes for, a basket of everyday goods and services.
So when GDP and CPI together signal high growth and rising prices, that's when the central bank gets involved.
Exactly. Which brings us neatly to monetary policy. And that's managed by the Federal Reserve, the Fed.
Yeah, it's always struck me as interesting how independent the Fed is from, Congress and the president. Gives them enormous power over borrowing costs.
That independence is crucial. Think of the Fed as the economy's thermostat. If things get too hot, if inflation is a worry, the Fed needs to cool it down.
How do they do that? Raise the cost of money.
Basically, yes. They can raise the discount rate, that's the rate they charge member banks, but the main tool is open market operations, specifically selling government securities like bonds.
Selling bonds. So they're pulling cash out of the system.
That's the effect. It sucks cash out of the banking system, tightens up liquidity, and that pushes interest rates higher across the board.
Okay. And the reverse is true if the economy is sluggish.
Right. If the economy needs a boost, the Fed wants to encourage borrowing and spending, so they'll lower rates and they'll start buying back government securities.
Injecting cash back into the system.
Exactly. Makes money easier and cheaper to get, which hopefully spurs investment and gets things moving again.
But the Fed isn't the only player, is it? There's also fiscal policy.
Absolutely. Fiscal policy, that's the spending and tax decisions made by Congress and the president. While the Fed fiddles with the money supply, fiscal policy can change the actual demand for money and goods.
Like when the economy slows down, we often hear about stimulus packages, infrastructure spending, maybe tax cuts. Yeah, things aimed at boosting demand, creating jobs. But one thing our sources highlight is a potential problem: political gridlock. When Congress and the president can't agree.
Right. That kind of dysfunction can create economic uncertainty. Businesses might hold back on investment, consumers might get nervous, and that can actually work against what the Fed is trying to achieve. It dampens confidence.
So, okay, we have this policy environment setting the broad interest rate levels, but how does the system make sure that when, say, the Fed lowers rates, the lenders actually have the money to give out all those new loans people want?
Great question. And that brings us to the two-tiered market structure. This is really the core of how it all works in the U.S.
Okay, 2 tiers. What are they?
First, you have the primary market. This is where the loan is originated. It's that interaction you have, sitting down with a loan officer at a bank or credit union, applying for the loan, and getting the funds.
The starting point.
The starting point. But then almost immediately sometimes that loan gets moved. It's sold into the secondary market.
Okay, why? Why sell it so quickly?
Think of the secondary market as the system's capital recycling center. The primary lender, the bank you dealt with, makes the loan, but they need their money back quickly so they can make more loans.
So they don't have to wait 30 years to get paid back bit by bit.
Exactly. Waiting 30 years would mean they couldn't lend to the next person who walks in the door. The secondary market's main job is to buy up those loans, which instantly replenishes the primary lender's cash supply. It keeps the money flowing.
It's like a warehouse for money, constantly moving inventory.
That's a good way to put it. And the main mechanism for this is called securitization. They don't just sell loans individually.
Right, you mentioned this. They bundle them up.
Yeah, they pool together thousands of similar mortgages. Think of it like a big package of IOUs, and they sell shares or bonds backed by that pool. These are called collateralized mortgage obligations, CMOs, or more generally, mortgage-backed securities, MBS.
Okay, MBS. I've definitely heard that term. But wait, if my loan gets sold, do I even know? Does my payment address change?
Usually no, and this is a key point. The primary lender, the one who originated your loan, typically continues to service the loan even after selling it.
Servicing. What does that entail?
It means they still collect your monthly payments, manage your escrow account for property taxes and insurance, handle customer service questions, and then they pass the principal and interest payment along to whoever actually owns the MBS, the secondary market investor.
So the bank I send my check to might just be acting as, like, a processing agent.
Essentially, yes. They collect a servicing fee for doing that. Today, it's often around, say, 0.3% of the loan balance from the secondary lender who actually owns the debt.
Wow. So the real owner could be some huge pension fund or investment firm somewhere else entirely.
Could be anywhere in the world, potentially. The money just keeps flowing. Okay, so now let's zoom back in on that primary market. Who are these originators?
Our sources break them down into about 3 functional types.
Okay, 3 types. What's the first?
The most familiar is probably the retail lender. This is your typical commercial bank, savings and loan, S&L, or credit union. They deal directly with you, the borrower.
And sometimes they keep the loan.
Sometimes. If they hold on to it instead of selling it, that's called a portfolio loan. But even big banks sell a lot of their mortgages.
Okay, type 2.
That's the correspondent lender. These are often smaller lenders. They'll take your application, process it, and actually fund the loan at closing, maybe using their own money or often a short-term line of credit.
But they don't keep it long.
Nope. They have a prearranged deal to immediately sell that loan, like the moment it closes, to a larger wholesale lender. They're basically a temporary bridge, a conduit.
Got it. And the third type, the wholesale lender. This is a mortgage investor, often a larger entity, that doesn't deal directly with borrowers. Instead, they work through mortgage brokers. The wholesale lender sets the loan pricing, the guidelines, decides if you qualify, and provides the funds.
Ah, okay, so that brings us to mortgage brokers. They aren't lenders themselves, you're saying.
Correct, and this is crucial. Mortgage brokers don't lend money. Their job is to act as an intermediary. They work with you, the borrower, to find the best loan product from various different wholesale or institutional lenders.
So they shop around for you.
Exactly. They prepare the loan package, submit it to the lender they think is the best fit, and if the loan closes, they get paid a commission by the lender, not usually by the borrower directly. They offer access to a wider range of products.
Okay, that makes sense. Now, within these retail, correspondent, and wholesale functions, we have specific types of institutions, right?
Yes, the formal institutional lenders. For example, savings and loan institutions, or S&Ls, were historically huge players in funding 1 to 4 family homes.
And commercial banks.
Massive providers. They do tons of residential mortgages, but also finance big commercial projects, shopping centers, office buildings, you name it.
What about credit unions?
They're important, though maybe not the biggest source for first mortgages. Where they often shine is in secondary financing, like home equity loans or lines of credit. Their non-profit status can sometimes let them offer really competitive rates.
Okay. Any others?
Yeah, mortgage bankers are significant. Unlike commercial banks or credit unions, they don't take deposits. They raise capital by selling stock or issuing bonds.
So they're purely focused on originating and selling loans.
Pretty much. And smaller mortgage bankers often use something called loan warehousing. Basically, they borrow short-term funds from a commercial bank to fund the loans they close. They bundle these loans up, that's their warehouse, and then quickly sell the whole bundle on the secondary market to pay back that short-term credit line and make their profit.
It's all about speed and volume, moving that money.
Absolutely. We should also briefly mention insurance companies. They don't do many individual home loans, but they invest heavily in large commercial real estate projects. And government lenders, like state housing agencies, sometimes issue bonds, often tax-exempt, to fund special low-interest loan programs for specific groups like first-time homebuyers or veterans.
And then there are non-institutional players, too.
Right, non-institutional lenders. Think private individuals, maybe university endowments, investment groups, finance companies, they might buy or make loans, often second mortgages, looking for higher yields. Seller financing exists too, though it's less common today.
And we have specific investment vehicles like REITs.
Yes, REITs, real estate investment trusts. Investors buy shares in a trust that owns actual real estate, mostly commercial properties. The income flows through to shareholders. And slightly different are REMNTs, real estate mortgage trusts, which invest purely in mortgages, not the properties themselves.
Okay, wow, that's a lot happening just to get the loan started.
Mm.
Now let's shift focus to that secondary market.
Yeah.
The buyers, the recyclers. This is where the big names come in, right? The GSEs.
Exactly. The government-sponsored enterprises. And the biggest, oldest one is Fannie Mae, the Federal National Mortgage Association, or FNMA. It started way back in 1938.
During the Depression, right? To get mortgage money flowing again.
Precisely. Its core mission today is still to expand the secondary market. It buys vast quantities of mortgages from lenders, packages them into those mortgage-backed securities, MBS, and sells them to investors. This provides that constant flow of cash back to the primary lenders.
And Fannie Mae sets standards.
Hugely important. Fannie Mae develops the underwriting guidelines for what qualifies as a conforming loan, the standard bread-and-butter mortgage. They also have a powerful automated underwriting system called Desktop Underwriter, or DU, that helps lenders make approval decisions quickly.
And its counterpart is Freddie Mac, the Federal Home Loan Mortgage Corporation, FHLMC.
Right. Freddie Mac was created later, in 1970, specifically to create a secondary market for the savings and loan institutions, the thrifts, which needed more liquidity.
So they do basically the same thing as Fannie. Buying loans, creating MBS.
Essentially, yes. Freddie Mac buys conventional loans as well as FHA and VA loans, securitizes them, and sells them. They have their own automated underwriting system, too, called Loan Product Advisor, or LPA. It used to be called Loan Prospector.
And both Fannie and Freddie are currently under conservatorship.
Yes. Since the 2008 financial crisis, both have been operating under the direction of the Federal Housing Finance Agency, the FHFA.
Okay, Fannie and Freddie buy and sell. But then there's Ginnie Mae, GNMA, the Government National Mortgage Association. How is it different? People often lump them together. Yeah, that's a common confusion, but Ginnie Mae's role is fundamentally distinct. It's crucial to understand this. Ginnie Mae does not buy or sell loans or MBS. It doesn't. So what does it do?
It guarantees. Ginnie Mae is wholly owned by the federal government, part of HUD. Its job is to guarantee the timely payment of principal and interest on MBS that are backed only by loans already insured or guaranteed by the federal government.
So loans like FHA, VA, USDA loans.
Exactly. Ginnie Mae essentially adds a layer of security. If a borrower with an FHA or VA loan defaults and the lender can't make the payment to the MBS investor, Ginnie Mae steps in. It provides a U.S. government guarantee, which makes those particular MBS extremely safe and attractive to investors globally.
Okay, so Fannie and Freddie create liquidity by buying and selling. Ginnie Mae creates security by guaranteeing the government-backed portion of the market.
You got it. That guarantee underpins trillions in market confidence for those specific types of loans.
Are there other secondary market players besides those big three?
Yes, there are specialty markets. For instance, Maggie Mae, which is actually MGIC, the Mortgage Guarantee Insurance Corporation, they were the first private insurer of conventional mortgages and helped create a secondary market specifically for those privately insured loans.
And Farmer Mac. Sounds agricultural.
It is. Created in 1987, Farmer Mac provides a secondary market specifically for agricultural real estate loans and rural housing loans. It offers guarantees on pools of these loans, similar in concept to Ginnie Mae, but for the farm sector.
Interesting. And one more acronym you mentioned earlier, REMIC. Ah, yes, REMIC. Real Estate Mortgage Investment Conduits. These were created by the Tax Reform Act of 1986. They are basically special legal structures used to issue mortgage-backed securities. What's special about them?
The key benefit is taxation. REMICs avoid being taxed at the corporate level. Only the investors pay tax on the income. This structure also offers a lot of flexibility in how mortgage pools can be sliced and diced into different types of securities, catering to specific investor appetites for risk and maturity. They really help attract more capital into the mortgage market.
Okay, so let's try to tie this all together. We've gone from macroeconomic policy all the way down to specific entities.
Right. So the big picture cycle looks like this. The Fed and fiscal policy influence the overall interest rate environment. Then primary market lenders, banks, correspondents, brokers originate loans, often using guidelines set by the secondary market. Then, those loans are quickly sold to the secondary market giants like Fannie Mae and Freddie Mac, or guaranteed by Ginnie Mae if they're government-backed.
Exactly. These secondary players pool the loans through securitization, creating MBS and other securities like REITs, which are then sold to investors all over the world,
And that sale pumps cash back into the primary lenders.
allowing them to make more loans. It's a continuous cycle designed to keep capital flowing constantly back into housing finance.
So for you, the listener, when you sign those mortgage papers at your local bank, that action immediately connects you through this complex chain to automated underwriting systems, federal policy decisions, and potentially global investors buying slices of your debt. It's kind of mind-boggling when you think about the scale. The whole system, especially the secondary market, is engineered for massive volume and constant reinvestment. Without it, the 30-year fixed-rate mortgage, which is pretty unique to the U.S., probably wouldn't exist in the way it does, or certainly wouldn't be as affordable or widely available.
That efficiency and liquidity are really something. Okay, final thought then. Given this incredibly complex, high-volume system, constantly recycling trillions in debt, what's a surprising non-real estate industry that you think might rely heavily on the smooth functioning and efficiency of this U.S. mortgage market? Something maybe unexpected.
It's a good one to ponder. What else gets pulled along by this massive financial engine? Something for you all to think about until our next